So there are three pillars of any decision. One is to look at activity in detail. One is to look at inflation in detail. And one is to look at where the market conditions are. And I think that when I looked at February's conditions, I thought that there would be a nonlinear change in the labor market that would be deleterious for growth and consumption, and that would lead to pricing power, reduction of pricing power of firms. And so that cascade from a very weak labor market into lower inflation was what I saw in the cards, and I thought that a 50 basis point cut in February was appropriate given those expectations, my expectations for market conditions. So where are we now, or where was I in the last decision? The first observation is that the labor market has been more resilient. Now, yes, we've had some prints that are indicative of a slowing labor market, but it is not a nonlinear adjustment. Number two, and actually much more important, are household expectations have in fact increased, both at the 1 year mark and the 5 year mark. I worry about that. Plus, goods price inflation has increased. PMIs for input and output prices has increased. And so that cascade from labor market weakness to pricing weakness did not happen. And then finally, the market's given me 75 basis points. I only asked for 50.
It's giving you the leeway you wanted as well.
So it's a hold.
Catherine, I thoroughly, my boss, as I said to you off air, but I might as well tell the viewers, my boss gave me the opportunity not to go to the lock-in for 2 hours last week. And I said, no, I learned so much from sitting there and reading your 96-page MPR, your Monetary Policy Report. It's precious time. No phones, no gadgets, no outside world. And I love it. Locked into the bowels of the Bank of England. And one section that I got to, which I found fascinating, and I know that my colleagues will ask you about international affairs as well, but I found the agents section always really interesting. The Bank of England agents, they go out into the country, they just basically tell the Monetary Policy Committee what they're seeing. Yeah. I read that the agents see a pretty gloomy picture out there, and I was wondering why that didn't influence your decision to go for 25.
So we go with the agents. They go around and set up, but we also go around the country and not only talk to the business community, but also to citizens as part of the citizens panels. The agents have been painting a lack of a robust environment for a while, and that's an important signal. And in fact, we find that the agents have been a forward-looking signal. However, until we see something in the until I see something in the inflation data that is persistent.
But Catherine, to jump in, you do see something in that the average weekly earnings figure we just seen was very encouraging. I think it was down to 5.6%. But and again, I'll probably mix up my numbers, but I'm pretty sure the MPC sees average weekly earnings, which is one of those two sticking points they were worried about, that and services sector inflation. You see that coming down to a 3 handle by the end of the year. That's pretty much a green light for more cuts, though, isn't it? If that was one of the two big things you were worried about.
Well, we put out a variety of things that we look at in detail. I look at a lot more things than that. And I'd have to say that right now, the labor market is a forward-looking, indicator. We look at DMP, the forward-looking wages, forward-looking pricing from the decision-maker panel. I need to see the loss of pricing power. I need to see that firms are starting to be much more moderate in setting their prices across a broad range of products. And as I said, the data that I've seen, goods prices inflation is actually going up.
Okay. Wow.
Not down.
That's a fascinating point, because front page of the FT today, the Chinese are taking issue with the US-UK trade agreement, worried that the Chinese are going to be squeezed out of the supply chain.
Right.
And one would have to think if that happens, then the pricing power is going to erode somewhat, because the American prices can by no means be cheaper than the Chinese, right?
So I think, there is, I will agree with my colleagues who believe, based on data, that there will be lower inflation on goods prices in the global economy. There will be some trade diversion that will lead to moderation of import prices in the UK. But there's a lot of margin between the dock and the shelf. And there are a lot of players in there who have had squeezed margins for an extended period of time. And they will look for an opportunity to rebuild those margins. So just because inflation is lower at the dock doesn't mean that we're going to see as much of a pass-through to lower inflation at the retail shelf. And that's where that margin in the middle, that margin in the domestic economy, is what I'm looking at as a very important indicator of whether or not we see the sort of the moderation that comes from all the trade stuff that's happening showing up at the retail level here in the UK.
Very fluid conditions you're highlighting here. The reality is that just this week we had movement on the massive agreement between the US and China, at least a row back from the embargo levels on tariffs. The decision you had to make, of course, somewhat preemptive before there was more progress on this discussion. Did it make any difference? I know you were cautious anyway as you were sitting at that neutral handle, but were you a little bit surprised that the decision had come through so quickly to row back at least, and would it have made any difference if the news flow had been slated a bit earlier than the decision?
So there's a lot of news, but there's not a lot of detail. And ultimately, how firms react to news is to sort of hold things stable, as opposed to start to cut price right away or to move their supply chains. Or, I think we've read things like who's putting things on the boats versus not putting things on the boats. So it takes a while for news to translate into actual policy and actual numbers. And only at that point can firms really be reactive in a consistent way. We might see some little blips, as I say, boats did arrive or they didn't arrive, with things on them or things not on them. But ultimately, that may lead to some volatility in inflation, volatility in prices. But we have to look at something that is more consistent, more trend, in order to evaluate the stance for monetary policy.
Let me take you back to one of your recent votes. In the most recent meeting, you obviously voted to keep rates unchanged. But before that, you were in the camp of going for a jumbo rate cut. Can you help us understand how you think about a 25 basis point cut versus a 50 basis point cut?
That's a very important question, and I appreciate your asking it. My view on how to deal with the degree of volatility in financial markets, and there is quite a bit of volatility in financial markets across a range of asset classes, and a lot of that volatility is coming from cross-border spillovers. It's a global marketplace for financial assets, so of course, we're going to be the recipient of volatility that's coming from other places. But in that environment where there is so much volatility coming from other sources, it's important to make it clear what your stance is. And in my view, a 50 basis point change is a clearer signal that comes from me. I'm making the choice, a clearer signal for what I think the appropriate stance of monetary policy is in the UK for the UK. I think 25 basis points gets lost.
In terms of that note around signaling and the votes, what should we read into the vote split this time round? Because that was perhaps one of the most interesting features, that it was a three-way split, not a two-way split this time.
Right. Well, I think that, I'm not going to speak for my colleagues, but we all look at the information, but we do interpret, I think, things differently in terms of, is it most important what's happening in the labor market? Is it most important what's happening at the pricing power of firms? Is it most important to think about what's happening on the supply side? So we haven't talked about that, the degree to which you believe that productivity growth on the supply side will recover or will take some more time to recover. And so these are parts of other people's decisions, and we weight them differently.
I want to pick up on some of the volatility in financial markets because we were in Washington, D.C. last year having a great conversation around capital flows. And a lot of that really around what happened in the COVID era and how rapidly money moved out of some markets. But we've seen it too in this window around the US dollar. And it's been surprising just how rapidly dollar is king story has unwound. And of course, it's been bumpy around each different trade story. What is taking place here? Because Trump is so fixated on correcting the trade deficit. But is there something deeper happening around the reserve status of the dollar that he is now undermining with some of this trade volatility?
Well, I think the dollar is still king. You know, you look at it, and yes, exchange rates move up and down, but to sort of suggest that the dollar isn't king anymore is a little premature. I do think that there's a lot of reassessment in portfolios about the appropriate composition of dollar versus other based assets. That's if we're having big changes in exchange rates, even algorithmic trading would alter the composition of an asset portfolio. So this, you know, to some extent, what we're seeing is an algorithmic trading.
Catherine, I think we've got you for a bit longer. You're not in a desperate hurry, are you? Oh, half and half, that one. Okay, well, we'll keep you for a bit longer because genuinely I could keep you for hours and chatting to you. So look, we spent a lot of time talking about the broader market and about Mr. Trump and about the world and about the 41 times plus that the NPR mentioned unpredictability or uncertainty. I want to go back to the UK because something that I picked up from talking to Andrew and now speaking to yourself and reading the report is that actually UK trade disruptions because of Trump account for 0.1% of GDP, 0.1%, whereas another 0.2 came from the global disruptions. So I want to go back to the real key factors for the UK, which is the UK itself. Right. And we haven't talked at all. In fact, no one asked a question about Rachel Reeves in the presser, which I thought was fascinating. Rachel Reeves has done good old-fashioned Keynesianism. They're going to be borrowing a lot of money and raising a lot of tax to deliver enormous growth to the United Kingdom, potentially. And in the February NPR, when I spoke to the governor, it was hard to see when and where the growth from all those initiatives comes into your 3-year chart. Have you got any update for us that you actually are beginning to see further down the line potentially the benefits of that? Because at the moment there are concerns that the increase in NIC is detrimental to the economy. The increase in taxation is detrimental eventually to the amount of money the government has to spend on other things. So is the growth, any sign of it coming through?
Well, of course, we take announced fiscal policy incorporated into our forecasts, and we have incorporated as you say, the Keynesian part, which was the expenditures that were distributed around the entire country, primarily through the health sector. That was very clear in November, coming through into our initial forecast. One of the things that I saw in November, I was very positive about that Keynesian sort of priming type of approach. But what we have observed is that pretty much most of that has been saved, which is not consistent with sort of past behavior of UK. I'm not British, but I'm American. We're Anglo-Saxon that way, and we tend to spend in the past. But these days, people have been much more concerned about volatility in their paycheck, how far it's going to go, whether or not they have to remortgage. These sorts of savings buffers have been very important. So the Keynesian aspect in the forecast, but has been essentially moderated by savings buffers by consumers. Now, what's also in the forecast is on the supply side, the role of planning and affecting housing, and infrastructure and the supply side of the economy. So we do incorporate those things into our forecast, and those do start to look, they're a part of the supply side growth assumptions that are embodied in the forecast itself.